Hello, everybody. Kirk Spano. It is 3 days to Turkey Day. Tuesday, Wednesday, Thursday. Yeah, 3 days. And you'll be eating yourself some stuffing. And right now, our portfolios have been getting stuffed with money, which is pretty cool. We are seeing that euphoria that I forecast at the start of the year happening right now. And I don't know how far it's going to go. We do know that the markets are getting very overbought again, and we'll look at TradingView for that. And we know that a lot of stocks are overvalued based on their typical price to earnings ranges over 5 and 10-year periods. So that plays into the whole Shiller ratio, the CAPE ratio that he uses, that shows that against the 10-year normal price to earnings ratio, the market is extremely overvalued. Now, analysts think that earnings are going to go up about 14% next year. Well, I think they're just making up for the fact that they underestimated how much earnings were going to go up this year. So they're going to miss next year by about what they missed by this year, just on the opposite side. So that means that right now, earnings projections are outperforming by a little bit. And I think that next year, earnings projections underperform by a little bit. The market hates that. So I've been talking about selling covered calls for the last few weeks. Now, most of the covered calls are just about right. There is a couple that were a little bit too low, and I'm going to show you how to roll those out today. Let's start with screening, though. Over at TradingView, when I set up a screen, I want to use weekly technical indicators. So I have this preset. Go here to my custom, and I have the technical ratings based on end of week measurement, not end of hour or end of day, end of week. The moving averages based on the end of the week, then the oscillator rating based on the end of the week. Why do I use weekly instead of daily? I use weekly because we're not short-term traders. If we were swing trading or day trading, we would want to use indicators that measure the market more frequently, every 15 or 30 minutes or every hour or every 4 hours or every day. We don't care about that. Unless you're over in the rare chat room on fundamental trends with Shooter, not only do you not need to measure things by the day, you don't even need real-time data, at least not on TradingView. If you are a very frequent trader trying to move in and out week to week, day to day, hour to hour, then you need real-time data. But otherwise, you don't need to pay for it. Why do I bring that up? Because right now is their Black Friday sale. So if you're a subscriber, and I'll actually put this link in the YouTube, I think it's actually already in there. You want to take advantage of this sale. This is hands down the very best sale they have every single year. Every single year I've used them, it has been this week or two period when you can get the best deal on TradingView. Now, I just want to point out here that they have different setups. So the plus is what most people need. The essential isn't quite enough. The premium I use because I build all the different screens, but you probably only need plus unless you really want to expand your screening capabilities, in which case you need premium. And I pay by the year because that is the cheapest way to do it. They give you a free month and a gigantic discount. So premium ends up being 70% cheaper. Yeah. So if I extend, they're going to give me another month and a bunch of money off. So I might actually extend mine. I mean, I'm going to have this forever. So if I extend an extra year out, that's fine with me. I think most people, though, you can use plus. If the premium ends up being about the same price as the plus, you might as well do the premium. But in general, if there's a price difference that's appreciable, you can just use the plus. So when I take a look at the stocks in the market, I don't want to just use that. Take a look at that. What I want to use is SP 500. I want to give you a good example. We're going to rate these by RSI, sort ascending. These are the stocks that are oversold. The RSI here is below 30. You can see not a lot of stocks. And the question that you have to ask is fundamental in nature. You take a look at all these and say, okay, these are all oversold right now. So let's take a look at Lilly. We know it's a good company. Been making money on the weight loss drugs. And it's down here to its 20-day moving average, which happens to be right at a resistance level. So if it goes below that, it would have to work to get back above it. This is the 50-day moving average on the orange line. Appears to be another resistance level. This is a different measure of resistance and support. So the big lines on the side, turn this one off. These orange lines on the side are the institutional fair value gap. So the professionals, the institutions, think that this yellow over the next year, because they use 1-year price targets, correct? I use 5-year price targets and 1-year price targets, but really most of the industry just uses 1 year. And I've always thought that was not a great time frame because it's too short. You don't know what the speed bumps are going to be. You don't know what the events are going to be. And it's just not enough time for companies to execute. So I look at more that 3 to 5 year time frame. I think I can be very, very accurate on that unless management screws up or something really changes from a competitive landscape or a technological landscape. But in most cases, I can adjust as the price changes direction. So when this stock got up here, when Eli Lilly got up to 959, the fair value gap, this yellow line, this yellow band, which is what the institutions are thinking, they'd want to buy at, started to pull the price down. Now, as price momentum goes down, momentum is what it is. Momentum is momentum. Price keeps going down. Each one of these orange lines are a level where institutions start to look at this stock. Now, interestingly, the Wyckoff spring, these green arrows, suddenly sprung to life. And they're saying you're going to see an uptrend, but probably not gigantic. So if you were a 1 to 2 year trader, or maybe even measured in quarters, you could probably buy Eli Lilly here on this Wyckoff spring. These are incredibly accurate. They don't make a lot of mistakes. See one here, see one here. The stock did nothing but go up. So what these don't do a good job of is telling you how big and for how long a rally will last. But they're pretty accurate as far as telling you a rally is about to start. So you probably get a bounce here. Here's your Elliott waves kind of showing you the range. This Elliott wave coincides with a fair value gap line. So I'd say that you're probably going to see Eli Lilly make a run at 1,000. And if the market really gets euphoric, get up here. I'm kind of conservative. If I was going to try to trade for a 25% gain, which is not really something that I do much of, you could buy Eli Lilly here. So if you happen to think Eli Lilly is suddenly fairly valued with a good future and the technical setup is saying rally, you could buy it here. But once it got close to 1,000, I'd be real cautious. Unless, again, your fundamental analysis is saying this is a $2,000 stock or something like that. So you always have to consider the interrelationship between what the fair value of something is versus what the price is, and then overlay the technical indicators, and in particular, respect the momentum. These reversal signals, this particular one that I use, is seriously, it's over 90% accurate. It almost never misses. So you're almost certain to get an uptrade in Eli Lilly here unless the market breaks. And you could do that sort of analysis for any of these overbought. And what did you notice with Eli Lilly? It said buy while its technical and moving average indicators still had not. So where can you see similar setups? So let's take a look at Mondelez. My guess is it looks a little bit like Eli Lilly, not a company I really follow. So again, look at these indicators, and you can see it's not backwards looking. It's just indicated. Indicated here, you got a little rally. Indicated here, you got a rally. Indicated here, you got a rally. Indicated here, it was a little bit early, but you got a rally. Well, you got a rally, but then a fall. So again, that points to the fact that it's good at telling you there's going to be a rally. It's not good at telling you how big and how long. So with this one, you take a look at your Elliott waves, and especially when they hit one of the orange lines, a fair value gap line, that's usually pretty powerful. So this stock could run up to about 80, maybe even 90. But again, is this the type of trade that I make? Looking for 20 and 30% moves? Not really. Not something exciting for me. It's too hard of a trade. But if I was that type of trader and I was okay buying it now and selling it in a few months, this is a good signal. All these things are pointing in the right direction for you. And it's where you see, again, the buy signal on the oscillator being rates of change. against the trailing indicator. So the rate of change is on your side before the trailing indicators catch up. As for the Wyckoff springs, there is no setting you have to do for that. That's all programmed in by the programmer. So that's built into TradingView. Nothing to mess with. This is just somebody else's algorithm, and it's all set up for you. You can mess with it. I never have. I think that QuantView is pretty good at what they do. About the script. QuantView is the programmer. They tell you all about it. So these guys are pretty good at what they do. So they have their own website. That's why they put these up and they put these scripts in there. It's a taste. But the fact that TradingView has a whole bunch of good scripts, you can just go here, editor's picks. You can find different things to use. And what you really want is to follow the wizard. Let's quick find the word wizard. TimeScript Wizard. There you go. These guys put out the best of the best. So Lazy Bear, I've used his. Used a couple of these. This guy is fantastic. I think Shooter uses one of his too. Lux Algo, super popular, right? So these wizards, if you use their scripts, you usually find something useful. And there's other ones too. But the TimeScript Wizards, these folks are pretty outstanding. Anyway, again, I just wanted to show you that you could pull up any of these charts that have that red, green setup, and you're probably right. So the Wyckoff spring hasn't triggered here, but if this goes up again, I believe it will. It's based on the start of an uptrend. But again, same sort of look, right? Here, let's look at Regeneron. That's a company that I am moderate to moderately bullish on. So they fell off a cliff for some reason. That is momentum that you need to respect, and it's still going towards the fair value magnet. So I wouldn't trade this. When this Wyckoff spring signals, that means that the downtrend is pretty much done. Like here, you got a little bit more downtrend, rebound downtrend, but then it went up. This one, that's a pretty good rally. So when this triggers again, probably down in here is my guess, then you can probably take a ride up. So I'm going to keep an eye on Regeneron because I think it's a pretty good company. So this is the sort of thing you look at and you go, oh, look, downward momentum. I have time to study this company to see if I want it at a certain price, and it hasn't signaled the uptrend yet. I have no idea who these guys are. They're on the SP 500 though. Again, oh, look at that. But this one, downward trend looks like it's broken. Doesn't mean it can't go down a little bit, but you should be scaling in here if you're bullish on this company in general. Wyckoff spring, magnet is above you, not below you. You don't have any, this is more white, this is the BASS. Usually when it's blue up here, you gotta be careful, but when it, that's a major oversold point right here. So let's take a look at what it looks like back here. So this got super oversold and it lasted for a year, but then you had a nice rally. Then it fell off a cliff. Probably an earnings thing, who knows? Red below sets up the rally, starts to get overbought with the blue. That's what that means. As far as it'll let me go. Blue, so look how big that blue bump gets. Falls off a cliff. Gets oversold. Super rally during the COVID bailouts. Again, what have I told you about all these COVID humps? They're anomalies. They're not real. All of this is real. All of this is real. That's fake news. That is an anomaly that should not have happened, and the markets are normalizing for that. So the way you should view that is in your head, have an eraser board and just change this big hump to make it look like that in your head. Wiggle, 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 rather than hump. All those charts in your head, you should be adjusting that way. Anomaly, normal. All right, and we can flip this over, and now we see all the overbought. The airlines, if you own airlines, let's just take United Airlines. I'll tell you right now, I think you should sell it. Don't even write a covered call, sell this thing. Look, horseshit, bullshit, zuck off. There's no way that it's worth that. No way. All-time high. You know what should be going through your head right now? Looks like bullshit. It is. Take a look at this. Look at that. There you go. Right? This is a bias score. Overbought. Those big blue spikes up. Overbought. That's as bad as it gets. But there's more. Let's change this to a monthly look. Let's measure at the end of a month. Is it still as bad? Pretty bad. Here's your RSI on a monthly. Bad as it is, as overbought as it's ever been. So when something is this overbought, and in my opinion, it's also overvalued, right? This is your fair value gap. This is what the institutions think over the next year it should be worth if the market was rational, which, we know it's not. But in a rational market, United Airlines should be 50-ish, not 100-ish. In fact, I think this is probably a short candidate. That's what I think. So if you were, inclined to be exciting, this is one that you probably could short or buy puts on. And you see a lot of these. Remember when I said you want green here to buy while there's still red over here? Look at all these. The opposite is true. All the oscillators are telling you, oh, it's changing. But the backward looks, the moving average and the technical ratings haven't changed yet. So rate of change basically right now versus what it did before. Let me take another one. Royal Caribbean Cruise. Because they'll do well in a recession, right? Please stop the insanity. AI is not going to help these guys, are they? Super capital intensive, labor intensive business. So this is probably another short candidate. And if we get whiffs of stagflation next year, which is the risk, right? The potential Trump trade is stagflation. We hope it's not. But Gary Cohen, during his first term, said he's doing things that are stagflationary. And it started to happen in 2019. And then COVID disguised everything. You got the anomaly that confused people and made them angry and made them weird and even more ideological. Charts don't lie, folks. They tell a story. Most of these are either sells, trims, or sell covered calls. All right, so let's switch over to our watch list. Look at our dividend stock. So of the dividend stocks that we follow, so the dividend stocks we follow, if you happen to have got in here, I know some of you bought Cummins, some of you own Energy Transfer. Look at that. A sell against, red against the green, high RSI. So Energy Transfer, which people have made a lot of money on, it's met its target. The magnet is a little bit below it right now. Each one of these levels are magnetic as well. I don't think you see a giant correction here. So 18 down into the middle teens somewhere. Elliott Wave says 14-ish, coincides with this fair value gap bar. It's not something that I would necessarily even sell because they have a big dividend, right? So if you own Energy Transfer, right now is a chance to probably sell a covered call because you're going to get some jitterbuggy now. So if you own Energy Transfer, I would take a look at a covered call. So let's play with that. Go over to option strat. How did this get dragged so far down? And we will do a covered call chart. If you own ET, I think you'd be looking at a $19 covered call. Let's say a $20 covered call to January. Get 20 cents. Junk. April. Get 50 cents, 51 cents. If you own Energy Transfer, you have to decide if the small moves from 1886 back down into here, right? So this 50-day moving average, that's not it. This one, that's 50-day moving average. Would a price down to 14-ish bug you? If it would really bug you, you should take some profits. Maybe sell, 30% of your position, 20, 30% of your position, with the idea that if it does go down to 14, you buy it back. I don't own it. So you can go through all of these. Where do you see a sell against the green? Parker Hannifin, Kinder Morgan, probably. Okay, this is one that some of us own. And then notice it's all the pipeline stocks. Williams, Kinder Morgan, Energy Transfer. Wow. I told you all the way in here, it would get into the middle 20s at some point. Okay, here it is in the middle 20s. What are you going to do about it, right? So let's take a look. Let's take a look at the January 30s, 29 cents. You get 1 cent, 1%. Whoop-de-doo. I think that Kinder Morgan is probably another one that you think about. Do I want to trim 20 or 30% of my position? Volatility in these stocks isn't high enough because people just don't see enough reason to speculate on downside. But this chart got it up to the fair value that I talked about for a long time. Now you have to decide. It's not cheap anymore. It's not super expensive either. Are you the type of person that just wants to do nothing with fair value? So I think what's going to happen now with Kinder Morgan, it probably chops for an extended period. Gets a correction, comes back, right? It's going to wiggle in this zone, right? So this was the trading range a long time. I think your new trading range will be up in here. And remember, I know this company pretty well. We've covered this one all the way back to in here. So you just go down. Where do you see a sell against green? And if you happen to own it, take a look at where it says neutral. Bristol Myers, it's rallied off that little spot where we bought it, right? We were buying it down here near 40. That's a pretty good rally for, look at how that Wyckoff spring worked. I think that pharmaceuticals are going to do well. I got called away on this one and I sold it. on this rally. So would I keep owning it? With the euphoric market right now, and I will tell you, hedge funds have been buying these stocks, so they might rally into year end as the mutual funds will buy from the hedge funds, right? So the mutual funds will do window dressing, and the hedge funds that already own it will sell to them. So this probably gets choppy the last week or two of the year. So you probably got a week or two of rally. If this one runs to 65, I would probably trim the heck out of it, right? Because this mountaintop up here, you shouldn't count on that coming back. But right here, this green box and this green box, these have to do with the fair value gaps. They coincide with this orange line. And look, this one, hit the bottom of this one here. Let's draw a ray for you. Bottom of this green box, tops of these green boxes, right? Support becomes resistance, resistance becomes support. So I think this can rally up to about here. Actually, I like this signal a lot. Could it go all the way up here? It could. I'm not that optimistic. We'll say it gets to here. So I bet, because this is healthcare, there's a little bit more premium involved. So let's take a look at the January 65, right? Because January is a couple months out. 65 is about where I think it's going to get. Just junky premiums. So let's take it. What would it look like in March? $140. There you go. I think you can sell the March 65 for $140. It's not a huge premium, but what is the dividend on Bristol Myers? Bristol Myers dividend is a $240 a year. So you can get an extra $140 selling this March 21st cover call for 65 bucks, and it still has $6 of upside for you. That's a pretty good trade. That's a good covered call trade for those of you who own Bristol Myers. You got that? March 65, take the $140. That's more than 50% of the annual dividend for the next 4 months, right? That math all sounds good. All right, let's take a look at what I did in rolling some of my options. So my Spire covered call, I wrote before they sold the maritime business, and I sold the December 14s, and I got 60 cents. And at the time, I think the stock was like 10 or 11. Well, the stock has rallied up to 16-ish right now, right? Is that where it is right now? About 16, right? Big update today. So I want to roll my covered call out. Gotta take a look at the calendar, see what it gives me. I think it can run higher. I think 20 is the top side in the next year or so. Gotta respect the momentum. But ultimately, I don't think the maritime deal was a good deal. I think that they didn't get enough money. And just knowing the nature of the management there, they're going to spend money. So while they're eliminating their debt right now, I promise you, they're not going to start free cash flowing a ton of money. I think they're setting themselves up to be bought, which is why I think they can be sold for, I think the company might sell around 20. Not a ton of upside left from 15.5 to 20, right? It's another one of those 30% trades that don't really get me too excited. If I'm making a trade with the idea that, hey, I can make a quick 30%, I'm doing it because I think that it could run even further. I don't want 30% to be my capped upside. I want 30% to be kind of my that's very likely, but it could double or triple or more. Build in more upside. So I rolled my 14s for December out to February 16. So I get an extra $2 of strike price. I actually received an additional 25 cents to do it. I didn't have to pay for this one. So what I bought to close on the December covered calls and then sold to open, I actually netted 25 cents to the positive. So I'm good 85 cents so far in pocket, and I get $2 more of strike price, or about 14% more upside. Well, for 3 months, 14% is pretty good. I mean, I know it doesn't feel good today because everything's to the moon, but 14% in 3 months, if you could do that over and over again, you would do it, right? All right, so that's Spire. AAOI. Now, my psychology here was when it was 20 and went down to 11, 12, I thought that was dumb. So I doubled down on this bet at 11 or 12. Wrote an article about it. When it got close to 20, I sold a covered call. So I was like, that's probably where it should be, in the 20s. Now, the stock kept on running. It became a FOMO-MOMO stock. So my $20 covered calls, which essentially with that dollar premium meant I doubled my money on the trade, wasn't so good anymore because the stock is now 38, right? So I was okay getting it called away at 21 when it was in the upper 20s. Now it's in the upper 30s. I'm like, wow, how can I capture some more of that? So here's what I did. And I did it in two pieces. I originally rolled it out to March 22.50 at really no cost. And now I've rolled it out to June 25 at essentially no cost. What do I mean at no cost? You got to buy back in the first one that you sold. So you buy to close and then you sell to open. Sometimes you got to pay more to buy one in than what you sell the other one out at, right? Sell to open. Buy to close can be more expensive than sell to open, in which case you're spending money. In this case, I didn't even write up the March one because it's all a wash. At this point, what you care about is how do I get my strike price to go from 20 to 25? Because in the next 6 months, if I can make 25% on this, and knowing that it's 38 right now, I'm going to get that 25% most likely, right? Would you do 25% every 6 months? Would you feel okay about that? So you roll this covered call from December $20 out to June 25, and what you're going to see, and it's within like a nickel or a dime, is that buying this one now and selling this one, the two premiums are about the same. So the premium to buy in the 20 and the premium to sell out the June are about a wash. And the net result is for 6 months in calendar, 7 months in calendar, you make 25% more, presuming it stays above 25. Now, what I will tell you, two things here. One, I don't ever want to play my options across the summer period until I'm really close to summer and I have a better idea. Why? Because selling May and going away is a thing because it's been true 70 or 80% of the time. So I really don't want to cross the summer selling low volume events matter more period. So I'm selling the June. Now, let's suppose we get out to April, May, the world is good, stock's still going up. At that point, I might roll it again. And then I might feel okay, bumping it out to September or October or November, December or something. But this is as far as I'll go now is June. Because I know people are, why don't we just roll it out to next January? Because a lot of shit could happen next year. What if this drops 50% and it's back down to 20 again? That's not out of the question. And honestly, I don't think this stock is worth more than around $30 a share. I just think it's FOMOing its way up right now. Because the people who didn't understand it was a bargain at 11 or 12, they don't understand that it's overvalued at 38. They're just trading the move. And when they're done trading the move, those straight ups can become straight downs. I just showed it to you with Eli Lilly and a couple of others. And that's an important lesson to keep in mind. With twice as many traders in the market today as there was in the 2017, 18, 19 period, when the crowd of traders moves, and remember, they're the money at the margin, so they impact price, the moves can be really big. And right now, we see charts that are showing third and fourth level standard deviations, meaning at the edge of the edge of the edge, maybe of the edge, of where they've ever been historically. Think of yourself laying on a cliff, and you peek over with your eyes. Still feel pretty safe. First standard deviation. Then crawl out so that your elbows are at the edge and you're over the edge all the way up to like the middle of your chest. Second standard deviation. Now you crawl out even further and you get on your belly and really you're over the edge all the way to your waist. Third standard deviation. That's pretty dangerous. Fourth standard deviation is you are somehow trying to balance on your knees horizontally, not kneeling. But you're somehow trying to have all that weight not fall over the cliff because your feet are still on the ground. It's a hell of a yoga trick. Fourth standard deviation. Any little thing goes wrong there with your balance or your muscles give out or liquidity in the market changes, you're over the cliff. Fourth standard deviation. Think about that. That's what those measures mean. We are seeing third and fourth standard deviations on more and more stocks. Remember when I talked to you about market breadth a while back? As it gets to 80 to 90% of the stocks above their 250 and 20-day moving averages, basically everything has gone up when 80 to 90% of the stocks are at the high end of their valuation ranges for the last 5 and 10 years. That's when the bull market is almost over, or at least has to take a breather. Those measures are about 80% right now. Depends on which one you look at. Doesn't mean the things can't go up a little further. Doesn't mean that you can't hang over the edge a little bit more, but it means it's almost time for the police to show up to the party. Bond vigilantes, a black swan, whatever. The Fed not lowering interest rates. All right. So I also wrote a couple of cash secured puts on Enphase because I made 2 trades here. One before the election in case Kamala won. And now that Trump has won and all the clean energy stocks just got waxed for a couple of weeks, did another one. Got on both sides. So I've sold 2 batches of cash secured puts on Enphase. The first is the $90 December, and I received $6 in premium so that my net buying price for Enphase would have been 84. That's 70 right now, but it had gotten down all the way to 60. I also sold the Enphase January $60 cash secured put and received 429. Feel pretty good about that trade. That's the one that we talked about last week. So at this point, I'm happy with the $60 puts. The $90 puts, not so much. What can I do about it? Well, I rolled the $90 puts out to May, and I lowered the strike price to 80. Now, remember these other trades with the put options, I actually got paid a little bit. I had to pay $1.35 net to make this trade. So that original 613 that I received, it actually cost me $1.35 to close the original $90 put and then open the $80 put. So my net received is 478. My strike price is down to 80. So, way over 10% their improvement from 90 down to 80. Still underwater because as we see, the stock price is 70. And my net is going to be 80 minus that 478 that's in my pocket. So my break even is about $75 on Enphase between now and May. We'll see what happens. If all of a sudden Enphase goes on a big rally and goes above 80, then I'm just good for the 478. My bias for next year is that the euphoria in the market ends sometime in the first quarter. Could even be right after this next Fed meeting. We're going to want to watch the odds of a cut in the futures market. It's been all over the place. At one point, it was 80% likely to be a cut at the next meeting. Then it was down to 30%. And now that Besant is the Treasury Secretary nominee, I think it went back up. We're not going to know for a week or two the likelihood of a interest rate cut at the next Fed meeting. I think in 2 weeks we'll kind of know. But my bias is that next year at some point, because we're at so many third and fourth standard deviations, because so many stocks have participated to the upside, because of what I see in liquidity, I think there's a pretty good chance that at some point next year, the S&P 500 is below 5,000. On Saturday, Teresa and Shooter and I spent 2.5 hours on the telephone in a Zoom call showing charts and talking. And every one of us, using different methodology, can see that the stock market next year can go into the middle 4,000s. The S&P 500 can go in the middle 4,000. Doesn't have to, but that is probably what would be required for the market to be fairly valued and no longer overbought. And it probably would be an overshoot. If there's a black swan, if there is a recession, if a trade war starts to go bad, if Russia uses a nuke, China goes for Taiwan, if Iran's oil structure gets blown up and energy costs go up, if they really slash government spending to the point where it causes a recession, which I think is way more likely than people think. We all saw a downside into the middle 3,000s, and the Armageddon zombie apocalypse level is in the middle 2,000s on SPY. That'd be a 55-60% crash. I don't think that's going to happen. I don't even think 3,500 is going to happen. But I think 4,500 to 5,000, better than a coin flip. Not a lot better than a coin flip, but if you flipped 20 times, I think it might come up, 11 times. Price under 5,000 on the S&P 500. Next year is going to be a harder year. That's why I coached you a couple of weeks ago. Think less about prediction and more about reaction. Protect yourself. Doesn't mean you have to sell everything. The cover calls are dandy. And respect the charts and do the best you can on valuations. All the data's out there. you can go here to advisor perspectives, and every month they update. Man, I didn't really hit you with that. Find valuation. About the 7th of the month, they do a chart. PE ratios by percentile. Good Lord. I must have done nominal trailing 12-month PE. So we're high, but not super high. The PE10 ratio, though, it's about as high as it can get. So again, for this to come down, either price has to come down or earnings have to go up. And they have another one. And the one that I'll show you the one that I almost always show you. So here's the Buffett indicator. Then here's this one. So this is good Lord. Man, they're just killing us with ads, huh? They didn't used to always do this. But these are 4 different PE ratios. Crestmont, who is an outstanding research firm. They call it cyclical PE 10, but it's Schiller. Q ratio, which is similar to the Buffett ratio. And then the composite regression. All of these are high. Not always the highest, right? 2000 is still the highest, right before the Great Depression. Q ratio was all out of whack in the 60s. And then you got that big bear market in the 70s. Then it rebounded, crash, rebound. So again, for timing purposes, this doesn't help a lot, but it does show you that we're getting to the point where we're overvalued again. And again, either price comes down or earnings goes up, or some combination of the two. The Buffett ratio, which I think is why he's selling so much, that, and I think he felt like Apple is just above fair value, and he made a ton of money. So the Buffett ratio is almost as high as it's ever been. Basically, the value of corporate equities, stocks, against GDP. So what would make this better? GDP has to go up more, or prices have to come down. And this level here is probably about where it has to be long term. It can overshoot down here. But as I've talked about, I think since the QE age began, and I don't think it ends in the next decade, I think we have another big wave of quantitative easing coming. I don't think that these levels here, right? Resistance becomes support, right? Resistance becomes support. And I think this area in here is where it has to get to be fair, be fairly valued. But from here to here, again, that would imply a 30 to 60% drop in stocks. Now, when I talked like this in 2007, people told me I was out of my mind. When I talked about this around 1999, people told me I was out of my mind. When I talked like this at the end of 2019, people told me I was out of my mind. Then when COVID happened, they say, see, it wasn't what you said. It was COVID. Hear me now, leave me later. Look at your portfolio and don't be complacent. Trim where you're supposed to trim. Sell completely where you're supposed to sell completely. And I understand that some of you have tax ramifications. Sell covered calls, a little bit out of the money, collect the premium. And if the combination of those two things is between 10 and 20% above the current price, you've basically just paid your taxes. Any questions? All right, let's call it a day. I don't want to scare you, so I'm not sure if it's time to be scared. I'm just telling you, we're looking over the edge, and I don't know if it's with our eyeballs or if we're starting to hang over, but we're at the edge. We're not still getting there. We're not 100 yards away like we were in the middle of 2022. We can see over the edge now. And are we safely just peering over with our little eyeballs? Or are we hanging over at the waist? Not positive. All right. Have a great week. Lots to come. Enjoy Turkey Day. Be thankful for the fact that we are in one of the best spots in the world. And then maybe, just maybe, 10 years from now, we look back and we go, it wiggled a lot, but we're still in pretty good shape. And remember, Winston Churchill, Americans always do the right thing. After what? They've tried everything else. It'll all work out, folks. Our job is to make money regardless of which way the lines move, and then live our lives the way we want to live our lives. Some respect. And as I have now put in my profile on x.com, by being an anti-extremist. It's the only thing that I'm anti right now. Anti-extremism. I'm thankful that most people are. All right. Have a great Thanksgiving.